Welcome to the Hedgehog and the Fox. This is Peter Economos from Blackwattle Tax. He has been instrumental in helping me with my business operations. So very honoured to have him on the podcast today. Pete.
G'day, thanks for having me, Alistair. I'll probably just do a quick intro to myself. I'm a chartered accountant by trade. I've worked at large international accounting firms and also in banking for a period of time. We set out our chartered accounting firm up about 8 years ago, started from scratch, and now we service the middle market, so dealing with anything from a mum and dad small business. Our largest clients are 50 mil turnover private business and everything in between.
Amazing, Petey. So I deal with a lot of business owners in that mid-market category, and a lot of the questions I get are around structuring. How do you ensure you've got the right structure to begin with? And it's something I thought about deeply when I kicked off my business. And a lot of people get to the midpoint of their business journey and they find they're in the wrong structures. So where I wanted to focus today's discussion was very much around structuring. How do we think about structuring our business effectively? We will get some insights from Pete. I then want to go into talking about keeping on top of your tax and just milestones throughout the year. And then the final thing, talking about the ATOs starting to get really pedantic and harsh on some business owners, which we'll go into. So we're going to talk about those three things in detail. But maybe just to kick off, where my personal journey, where I found myself about 6-7 years ago, where I had owned some equity assets, just shares in my personal name. And I had this realization of I had quite a few capital gains in my personal name, and then I had to shift it over into a new entity. And it was that light bulb moment for me that structuring is so important, particularly if you're thinking 20, 30-year plan. Pete, I know you've got many war stories, but how would you articulate to your clients when they come to you and say, I'm just starting a business or I've got this issue, how do I structure my business most tax effectively?
Yeah, I would probably say to start that structuring or issues with structuring would be in the top 3 issues that new clients come to us with, whether they're starting a business or whether they're coming from a previous accountant and didn't feel like they got the right advice. It would definitely be up there in the top 3, if not the top issue that we face. Whenever I talk to a client about structure, you've got to get an understanding of the background of that client and what their long-term goal for their business is. Because sometimes the sort of boilerplate template of setting up a trading company that's held by a family trust, 9 times out of 10, that makes a lot of sense for a small business. But there are instances where that's not the right decision or the right choice for a lot of clients. Quite often the biggest mistake a lot of new business owners start out, particularly when they're going down the company path, is they'll set up a company, but they'll just own the shares in their own. But then they won't realise that they're actually onto a good thing in terms of growing their business, and it's growing quite rapidly. And then shifting those shares from their personal name to a family trust is a CGT event. It has tax consequences, can be navigated through some small business tax concessions and CGT legislation, but it's not always perfect. So it's always better to tackle it first, particularly if you've got the money to do the setup right. Do it. It's set and forget, and get moving on your business, and then come back and revise it every year to see if it's still fit for purpose.
Yeah, just get it out of the way. And that was the one thing I leaned into, is I sort of said, look, this is going to cost me a couple of grand to set up. And then I did the numbers and I realized, okay, well, look, at the end of the day, that's 6-7 grand of tax that, if you're paying, 6-7 grand of income, which then would have been the equivalent of 2K corporate tax. So, it was a decision for me at the time. I sort of made that long-term plan. Let's just do it, get it out of the way. But just on structuring, I know for those individuals who do have a corporate individual owner to a corporate trustee, someone was telling me the other day that if you are a individual owner to a corporate trustee, you are meant to annually pay yourself any income, you're meant to declare that income as a dividend income. So is there any truth to that? I mean, I don't know if that was true, and he said it, his accountant told him, and he was looking into it, obviously. But obviously that's quite a key issue.
Without having the full background, the way that I'd make the most sense of that is if you've got a trading company, the benefit of having a trading company and tax planning around that trading company is that your profits can get quarantined in there every year. And in a tax efficient manner, you make a decision year on year about how you pay the money out. Do you pay it out as a salary? Have you taken it out as a dividend, franked or unfranked? Or are you paying it out as bonuses, or you're putting it into super? So you've got a few decisions to make about how you actually remunerate yourself from your base wage as well as the profits. The benefit of having a trust owning your shares is that if you do make the decision to pay a dividend that year, you can push it through your trust and push it out to your family beneficiaries in a tax efficient way. You don't have to, though, push it out of the company. So that's the real benefits. Tax delayed is as good as tax saved in a lot of ways. So you can make that decision year on year. Some years you might go, I just sold an investment property in my personal name. I actually don't want to take any income from my trading company this year because I'm going to be highest marginal tax rate. So I'm just going to leave the profits there. And my wife next year is on maternity leave, and we're going to push the money out that year. And that's a great way to save money. Being proactive about thinking, what about other life circumstances that are coming up period after period, and making decisions. Big thing I always say to all my clients is that a trust in an operating company structure won't always guarantee you a better tax outcome year on year. But if an option is on the table to get a better tax outcome, you at least have that option. If you own those shares in your personal name, you just don't have that option. It's just straight to you, straight to your bottom line, straight in your personal tax return.
Yeah, it's something I've started doing actually, has been sending income each year to my kids, and you get $430 tax free. Which, if it's a capital gain as well, you can give them the CGT number, which is, and with it, if you get the capital gain discount, so you can actually send them about $800, but which is better than a kick in the teeth. But so just for everyone as well to think through that, the trust is really an intermediary, and then you decide where you want to play, where you want to send those funds. So am I right in saying that technically you could send the funds from a trust overseas to any entity you choose, as long as it's a beneficiary?
Yeah, most trust deeds, particularly a more recent one that's been drafted, will be drafted in a way that it provides for bloodline family and a family network, as well as associates under the Corporations Act. So if you set up a new company, you can actually use that as a beneficiary, which is a lot of wealthy clients that we work with do. Quite often, they're always in the highest marginal tax rate, so they're not interested in pushing. And they might have a significant interest in a trading company, which year on year pays out dividends because they've got a pool of investors. Quite often, they use a bucket company, push the money through their trust, and they don't want to take that money personally, so they put it into their bucket company and figure out what they want to do strategically later on from an investment standpoint.
And pay 30% or
pay 30%
for an operating entity. 25.
So sometimes they can take advantage of another operating entity they have full control over, push it through their 25% tax rate, as well as the franking credit that they're getting from a franked dividend from their investment. So there are a lot of strategies that you can implement through these kinds of trust bucket company structures. The big point I make is that you've got to be talking to your accountant at least every 6 months to be able to really leverage that and make them aware that something's happening. You can sort of troubleshoot with your accountant to think about what options there are, and then the client feels confident to make those decisions rather than doing it after the fact and coming to their accountant after the tax year and going, I've just done X, Y, and Z. And when you go, well, you could have done X, Y, and this instead and saved a bit of money.
The general rule of thumb, if you think you're going to earn more than 10K of income, it's better off setting up a trust bucket company structure. Because, some people come to me and say, I just don't know if it's worth it. Well, the short answer I usually give, well, if you think you're going to make more than 10K of income, that's the point where it actually is much more effective to send it to you. Well, I mean, and everyone at home should do their own math, but that was the number I came up with. Is that the rule of thumb you use?
I probably tackle it in a more of a general sense with a lot of clients. If you are going to be taking out money out of the business above your base salary. So I always impress upon clients, I start a business and they're like, what salary should I take? Well, I'm like, well, you need to take a salary that you can live off month to month. You need to take a wage to live. And you should take a salary that's representative of the work that you do within the business. Because let's just say one day the business grows and you go, I don't want to work anymore. I just want to manage and oversee the business. You would need to employ someone into that role. So the first thing I always tackle is, what's the base salary that you're going to take? What's market rate for that? And you've got flexibility as a business owner to say, I want to pay myself overs or unders for whatever reason. But then you look at, okay, well, am I generating profit? If I expect to be generating profit in a short amount of time, the most tax efficient thing is to have a trust and be able to figure out how you want to push those profits out to you and your family each year in a tax efficient way. So it's a really critical thing. We've got a new client that we onboarded about 3 or 4 months ago. Range of tax issues that we've navigated with them, but one of the biggest ones, which we're in the midst of right now, is a tax restructure. They came to us. Business is scaling very quickly. They're doubling their revenue year on year. So currently they're at 5 million turnover. They would conservatively expect, if a couple of contracts go their way, to be at 8 or 9 mil by the end of next financial year. So right now, two business owners own the shares in their personal names, and we've sat down with them to talk about converting those to family trusts, because if they leave it any longer, it's highly likely that they'll fall out of eligibility of some small business tax concessions. Because right now, we can help them potentially mitigate them to nil. But had they set it up day one in the right way, they would have incurred, let's say $3,000 a pop for each family trust. It would have been set and sort of semi-forget and revisit it later on. Now they're coming to us and they've still got to pay the costs to set up those trusts, but there's also advisor fees and other ASIC fees and things that we have to charge to actually get that work done. So it's actually more costly for them to do it now, even though the business was only set up 3 years ago.
But then again, if they had kept waiting for another 2-3 years, by the sounds of it, would have cost them in the 50Ks, it would have cost them several hundred thousands of dollars, if not more.
Well, I think on an indicative calc that we did, they're likely to have to contribute, in lieu of paying the tax, contribute to their super fund under the small business tax concessions, and it might be in the vicinity of 50 or 100K. It's highly likely, because of the way the business is rapidly growing, that they could quickly fall out of the eligibility of it, because the business is worth a lot more in a year or two's time, and then you're just up for a straight tax bill that really hurts. And where you find that cash, you're probably funding it from the working capital of the business, because not everyone would have 300 or 400 grand just sitting around that they can pay a tax bill on. They've usually invested it somewhere. And then that has roll-on tax implications, because you've taken out 300 or 400 grand to pay a CGT tax bill that you've incurred personally from a business, but then you've also got to pay tax on the money that you've taken out of the business to pay the tax on the CG. It becomes a little bit of a vicious cycle and a costly exercise. And we always impress upon any new client that comes to us that isn't in an ideal structure or a decent structure. It's one of the first conversations that we have.
No, I love it. I just think it's so important, and I do impress upon this, and I know a lot of business owners don't necessarily think about this when they're first setting up their business. They're very worried about their customers, but it is my one bit of advice. If I ever talk to anyone, I said, just make sure you have a very detailed discussion with your accountant, and if they don't know one, I've got a very good one who I know. But it's very important, just because I've seen it cost business owners down the track.
That's probably a big point that I see firsthand is people get very excited when they're setting up a new business and they're thinking about, okay, what do I need to spend for marketing? What do I need to set up to get my compliance right? What do I need to spend to just get the operations running? And you're just hungry for clients and customers. It's quite often those costs that an accountant comes to you with are really taken as secondary costs, and you're like, well, that can wait. And sometimes they can, and sometimes that's the advice that we give, because we know they're really bootstrapping their business, and that $3,000 can be put to some heavy invest into marketing. But we say, I want to sit down with you at least in 6 months' time and revisit this conversation, because you leave it too long and it could be a much more costly thing than just $3,000 to set this up. So
absolutely, and not only that, but I mean, I think it's good for buying any assets. And the problem is that if you're buying shares in your personal name, and I know a lot of people who just buy, never sell, set and forget. The problem is they've left it 5 years, and now those shares have doubled, if not tripled, and then to do anything with it, / they want to pay, give some of the income to their wife, or maybe contribute a bit more in super, or send it to a bucket company. They have no option, right? They're stuck. And if they've moved up in their income scale, they're now paying top marginal tax bracket, and they've sort of got this pickle. But no, that's great conversation, and particularly for business owners, you've got to use these tools available to you. And one of the big ones I always impress upon my clients is if you can set yourself up right as a corporate entity, and ideally reduce your non-deductible debt as much as possible. Because remember, non-deductible debt, you think about the flow of cash, the cash comes from where you earn it. You then pay tax. Sometimes you might distribute it prior, but sometimes you've already paid tax, distribute it to yourself. Then you pay tax again, and then you pay off your debt. Yeah. Whereas if you can shift that cash flow to prior to paying any tax at all, you instantly reduce your effective tax rate and the way to calculate it is your tax rate multiplied by your interest rate is the effective tax rate. So a lot of people come to me and say, I've been quoted business rates which is higher than a home loan rate. And I say, well, yeah, you might have been, but you're worried about, 10, 15 basis points. But the reality is you're going to save yourself like 3-4% through if you get your structure correctly right. And I showed a client, if he was able to refinance and recycle his debt, he would be able to increase the free cash flow to him and his family by 3 times the amount of cash. So at the moment, to put that in numbers, he and his family, as free cash flow after he's paid all his obligations, is call it 100K. After we've recycled the debt, he can increase that to 300K just through a better structure. Particularly if you're a professional, a lot of medicos, a lot of barristers have to operate in their personal names. If you get this right to start with, it's so important. Now, shifting next topic, Petey, how do we keep on top of our tax year in, year out? What are some of the things, quarterly BAS? What are the sort of small little nugget and reminders? Do you set yourself 15 days
that track what we have outstanding and have work to do for clients? We take a proactive approach, and a lot of clients like the informality of the relationship of us emailing or calling them and saying, hey, the quarter end is up, please send us your stuff. Because a lot of how information is exchanged between a client and an accountant isn't always a standard way. Most of our clients are on Xero, some of them are not. So, we're not going to go and ask our client to send us information when we're on Xero and when we're looking at their accounts pretty actively. But the ones that don't have Xero, they might need to send us their bank statements and other information. One thing that a lot of new business owners get overwhelmed with, and it's not getting any easier, is the amount of compliance, even just from a tax perspective, that a business owner has to navigate. You've got to do an annual tax return and financials. You're probably on quarterly bases. Once you reach a certain point with your wage bill, you also have to go on to monthly IASs, so reporting your PAYG withholdings for your staff on a monthly basis. If you're paying staff weekly, fortnightly, monthly, whatever, you need to be reporting single touch payroll. Certain industries like the construction industry have to lodge TPAR reports, which are basically reports about the contractors they've engaged for the year. And then you get into state authorities around payroll tax. You've got to have workers' comp and you've got to do your annual wage declarations. There's a lot of compliance, and staying up to date with it can be actually quite overwhelming for a lot of business owners. As accountants, we try and take off a lot of that load and really manage that core piece. And we're usually client-led. We'll have our systems and processes in the background that we'll follow, that will keep us, on track. But some clients just want a quick email and they're short and sharp. Other clients want a bit more of a robust hand-holding exercise. I have a handful of clients that will come into the office and sit here, and I'll actually go through their computer with them and get all the information because they're a little bit older, not as tech savvy, and they just need that hand-holding. So you got to kind of lean into the client.
Absolutely. And it's so compliance heavy that for a lot of business owners, they're so focused on what they do in their operations that they kind of park that to one side. And having an expert who can manage that for them and give them the degree of hand holding is crucial. No, I love it. So Any little nuggets for business owners? Just make sure you've got the right partner. I think sounds like it's key. Yep. Make sure you're getting automated reminders for your compliance and just keeping on top of it.
I think the best thing you should always be able to rely on your accountant to keep track. But I do impress upon the clients as well that at the end of the day, you're the taxpayer. You're the one that's liable. The ATO will hold you as the taxpayer accountable, regardless of what your accountant's done. That becomes a separate matter to deal with if you think you've been hard done by your accountant. But at the end of the day, the bill stops with you. So I do tell clients that you should have these in your diary, these reminders. You got to figure out your own system. We'll be there. We'll be doing the same thing and keeping track. But you can't always just rely on someone. I do it as well. There's certain aspects of my business that I've got external advisors for, marketing and things like that. We have diarised schedules, but I also have my own internal diary to make sure that I'm keeping a track on what they need to be doing. So,
100%. No, I love it. All right, our favourite topic, the ATO. I was talking to a friend yesterday who's got a fair bit of ATO debt, and he's found himself in a bit of a pickle. Recently bought a business, and he's just going through that early teething process. But I was trying to tell him that the old environment of the ATO has very much changed, and I was imploring him to get himself onto an expert like yourself, Petey. But if we think about ATO 2 years ago and we think about ATO today, the big thing in my mind is, this is nice, friendly bear, and this is the big bad bear, where the ATO is coming, they're not playing any Mr. Nice Guy anymore. They want their money and they want their paid today, and everyone else stand behind because the ATO comes first. How are you seeing the ATO at the moment?
I think there's one reason and one reason alone why we are in the current environment that we're in, and that's the incentives and stimulus that were pumped in during COVID. The ATO lulled taxpayers and businesses into a false sense of security by giving everyone these ATO holidays, allowing for delays in lodgements, delays in payments. And over that 2-year period, the small business debt that is owed to the ATO has ballooned to about $35 billion. Of that $35 billion, I think by last count, about $16 billion is owed by about 80,000 small businesses. So not a lot. It's less than 1% of small businesses owing such a substantial amount of money that is, for lack of a better word, probably unrecoverable. So near half that debt is probably unrecoverable debt. The ATO's cost of collecting debts has increased significantly. All these factors at play have meant that the ATO has taken this more hardline approach, and you're seeing it through every metric that the economy tracks. They are issuing director penalty notices at an ever-increasing rate. Rates of corporate insolvency are increasing, and 9 times out of 10, the ATO is the largest creditor and probably the one that's pushing it. The ability to collect on the ability to get interest remissions and penalty remissions has dropped from around 90 or 95% pre-COVID. Now it's down to about 70%. So the ATO is getting more strict about saying no to interest and penalty remission, even after the debt's paid in full. So they've taken this hardline approach, is putting a lot of pressure on businesses. And it's caught a lot of business owners off guard, thinking that the ATO will act in a certain way, but they have very much changed track.
Yeah, it puts it in perspective, doesn't it? All those you talked about. And I suppose one thing that I tell a lot of people, and I'd love your insight on this, is ATO interest at the moment. We just talked about recycling your debt to get a most tax-effective structure. Well, instantly you've turned, because you're an obligation, you're a pre-tax obligation, and ATO interest is non-deductible now, which is just massive. So if you pay any interest on ATO debt, you're paying it at 10.5, is it? 10.
So on BAS's last count was around 11.3%. A couple interest rate drops mean that might be slightly lower, but the effective rate is significantly higher, 16, depending on how you calculate it.
And really, however whatever tax you're paying.
High teens is the effective interest rate. So you're almost at credit card interest rates, and it's non-tax deductible. to that point, it's only come in from 1 July. On the lead up to that change, we were having a lot of these conversations with clients that do have tax debts to say you might need to consider an option about potentially refinancing your personal mortgage, put it in as a business loan. At least it's tax deductible then, and pay out the ATO. And you've got more favourable terms, i.e. payment arrangement with the ATO can only be up to 3 years. Obviously, if you're refinancing a residential mortgage, it can be 25, 30 years. So it gives yourself breathing room. I actually worked on a restructure with a client earlier in the calendar year, and they were paying an ATO payment plan. It had them around $2 or $3 grand in the red every month. So they were basically cash flow negative. We helped them navigate a restructure, and then they refinanced their mortgage, took out $200 or $300 grand, paid out the ATO, and they ended up being cash flow positive $5 grand a month. So they went from
seven
business
grand
against
flip.
the wall, business against the wall, to a very manageable lifestyle. Tax debts are cleared, business is back to operating mode, and they can just breathe a sigh of relief and get back to it.
Unbelievable. And I know, particularly, so if you're an individual as well and you're paying any interest as an individual, obviously, as you say, that is 20%.
Yeah.
20% is the effective rate, as you say, credit card rate. So long story short, if you are at all thinking you're going to be, one of the most important creditors, as Pete's saying, most of the wind-ups and insolvencies have come from the ATO. Don't get on the bad side of the ATO. In other words, be on top of your obligations. Make sure you're talking to your accountant about compliance, and don't be paying any interest. Amazing. Any closing comments, Petey?
I'd probably just touch on the point that you made earlier around debt recycling. It is actually really important for better tax outcomes to optimise how your loans. We've just recently given advice to a client who's going to sell an investment property in their personal name because they were going to go build a house. They've got an investment property in their personal name, but they also have a family investment vehicle, and they're selling it to the family investment vehicle, incurring CGT on it. There's going to be stamp duty on it. All in, they're probably going to be up for 60, 70 grand in tax and transfer costs. But it's going to be about an 800 grand sale. That money is going to be recycled back out to them, and then they can use that after-tax money to build their house. And then they've got a tax-deductible loan that they've thrown into their investment vehicle. So first year they'll be in the red on it. Second year they might be break even. Third year they're going to be going to be a positive financial outcome for them. Most mortgages take the better part of 15, 20 years to pay off. So they're going to reap dividends down the track for having made that decision to shift an asset, which 9 times out of 10 is not a good decision to make, incurring the tax, incurring the stuff. But when it comes to recycling and getting your loans in the right place so you can optimize your structure and your tax deductibility, it's really important.
And another thing on that is a lot of business lending is often interest only. So you can then decide, do I want to actually repay the debt, or actually I'm quite comfortable, if my effective interest rate is 3%. At the moment, that's the effective interest rate. If I can put my capital to better use elsewhere, and I think I can earn more than 3%, then let's do that. Yeah. So it just gives you that flexibility. Whereas residential home lending, you must pay me back, you must pay the bank back, but you're paying a term, usually 30 years. Yes, you've got a bit of time, but important to note that there is a clear difference between P&I and most business lending, if it's fully secured, is interest only. So pretty amazing. My key nuggets for today were get your structuring right early. Second one being ATO is very fierce at the moment. Don't upset the tax man. And the final one, make sure you've got good advisors on your side who are reminding you of your obligations and keep you on top of your business so you can focus on what's important, being your business. Any nuggets from you?
No, you hit the nail on the head.
Sounds good. Thank you for joining us at the Fox and the Hedgehog.
Thanks.
Cheers.